Hello and welcome to Market Pulse, where your AI host helps you to generate wealth and knowledge. Today we focus on a topic that might sound distant but has direct consequences on your portfolio: the US-China tariff deal. While headlines shout truce, what's quietly unfolding underneath is a strategic shakeup in global trade dynamics. And India? It's right in the middle of it all. So what is latest on the US-China tariff deal? After months of tense negotiations, trade delegations from the United States and China have announced a partial rollback of tariffs. The US has agreed to reduce duties on a range of Chinese goods from a sky-high 145% to a more manageable 55%. In response, China has agreed to lower its retaliatory tariffs to about 10%, particularly on electronics, pharmaceuticals, and agricultural imports. Importantly, both sides have pledged not to implement any new tariffs until 9 July, marking a cooling-off period that could either lead to a full-scale trade restoration or another flare-up. This agreement de-escalates the immediate trade standoff. It ensures critical US supplies of rare earths, stabilizes student visas, and freezes tariffs at the newly negotiated 55% and 10% levels. However, it's a framework, not a final, detailed pact. This may sound like a sigh of relief for exporters and investors in both countries. However, the implications for third-party economies like India are anything but simple. The world's two largest economies might be taking a step toward cooperation, but this very move could reshape global supply chains, reorder market shares, and shift where investment dollars land next. Let's unpack what that means for India, and more importantly, which Indian companies are poised to benefit or bleed. We have Raghav Sharma, the AI expert, who will share with us the insights.
Hello Priya. Thanks for inviting me. I hope my analysis will be helpful for the investors who want to be informed investors. India's trade relationship with the United States has grown significantly in recent years. As of the fiscal year 2024-25, India exported goods worth approximately $86.5 billion to the US, a 12% increase from the previous year. The US now accounts for nearly 18% of India's total exports, with major contributions from sectors like electronics, textiles, chemicals, pharmaceuticals, and IT services. On the flip side, India imports significantly more from China than it exports to it, leading to a massive trade deficit of around $70 billion. This imbalance also creates opportunity. Over the past few years, US buyers have actively looked for alternatives to China, and India has often been their first choice. Indian manufacturers across sectors have responded by ramping up capacity, improving quality, and entering new global supply chains. But now, with the US-China tariff wall beginning to come down, some of these hard-earned gains may be at risk. Let us look at the companies benefiting from the tariff shift. Tata Electronics has emerged as a standout performer, especially as Apple continues to shift its iPhone manufacturing base out of China. The company's state-of-the-art facility in Hosur, Tamil Nadu, is expected to generate annual revenues exceeding 15,000 crore by 2026. With over 97% of India-made iPhones destined for export, mainly to the US, the financial upside is clear. Analysts project a 200 basis point improvement in Tata Electronics' EBITDA margins over the next 2 years, driven by production-linked incentives and improved scale. Dixon Technologies is another frontrunner, riding a wave of global electronics outsourcing. In FY24, the company reported revenues of over 17,000 crore, a 34% increase year-on-year. Net profits rose by 33% to nearly 600 crore. As global brands look to India to mitigate geopolitical risk, Dixon is scaling up its mobile, LED TV, and white goods divisions. Its EBITDA margins, currently around 4.5%, are expected to rise as it adds high-margin ODM, original design manufacturing, contracts. Bharat Electronics Limited, a state-owned enterprise in defense and electronic manufacturing, clocked revenues of 20,200 crore in FY24, with a net profit increase of 25%. What's notable is a sharp rise in international inquiries, with its export order book swelling by 40% year-on-year. With the US exploring defense partnerships that exclude China, Bharat Electronics stands to benefit from a more stable procurement environment and an expanded pipeline. SRF Limited, a key player in fluorochemicals and specialty chemicals, is also reaping rewards. In FY24, the company posted revenues of 14,900 crore with net profits of over 2,000 crore. US buyers have shown heightened interest in its specialty chemical products, leading to a 300 basis point increase in margins over the past 18 months. With growing global concerns about the reliability of Chinese chemical exports, SRF is expanding capacity and investing in R&D to maintain its edge. Welspun India, a global home textiles giant, continues to deepen its footprint in the US retail market. Supplying to big names like Walmart and Target, the company reported export revenues of 6,800 crore in FY24. Its gross margins improved from 37% to 41% last year, driven by improved product mix and lower input costs. With China easing textile exports, Welspun is proactively expanding capacity and strengthening its US distribution network to hold onto its newly gained shelf space.
Can you also walk us through the companies at risk from easing tensions?
Sun Pharma, India's largest pharmaceutical firm, generated over 45,000 crore in revenue in FY24, with 35% of that coming from the US market. The concern is that as China re-establishes its pharmaceutical supply chains with American partners, pricing pressure on Indian generics may intensify. Currently, Sun Pharma enjoys an operating margin of 26%, but even a 2% drop due to price renegotiations or reduced order volume could shave off hundreds of crores in profit. Dr. Reddy's Laboratories posted FY24 revenues of 25,000 crore with 44% from North America. The company has a strong product pipeline but remains vulnerable to shifts in US sourcing policies. With net profit margins at 18%, any disruption in volume or price could have a disproportionate impact. The management has indicated cautious optimism but is ramping up diversification to Europe and Latin America as a hedge. Infosys, though not directly exposed to tariffs, earns over 60% of its 1.6 lakh crore revenue from the US. The risk lies in discretionary IT spending. If the easing of US-China trade tensions leads American firms to allocate budgets toward capital expenditure in China, India's tech giants could face growth stagnation. In FY24, Infosys reported a slowing revenue growth rate of 4.7%, a significant dip from its 12% average over the past 5 years. Motherson Sumi, now operating as Samvardhana Motherson International Ltd, is deeply entrenched in global auto component supply chains. The company reported FY24 revenues of 85,500 crore, with exports making up 70%. If Chinese suppliers return to aggressive pricing post-deal, Motherson may be forced to reduce its own prices to remain competitive. Current operating margins of 6.8% could compress by up to 150 basis points, especially in its European and North American contracts. Titan Company, primarily known for its finished jewelry brand, posted FY24 revenues of 46,000 crore. While its global jewelry exports are still modest, Chinese competitors regaining traction in the US market could limit Titan's overseas expansion. Exports currently account for about 6% of revenues. A significant pushback from Chinese brands could flatten growth in this segment, especially in the high-margin wedding and premium categories.
Amazing. That is a superb analysis and so simply put across. It will be great if you can summarize the sectors and India's road ahead.
The current landscape reveals a clear division. Sectors such as electronics manufacturing, specialty chemicals, defense technology, and textiles are on the rise. They are seeing improved margins, rising order books, and long-term growth potential. These companies have not just benefited from the trade war but have built durable competitive advantages. Conversely, sectors like pharmaceuticals, IT services, auto components, and gems and jewelry are under threat from revived Chinese competition. Their profits, margins, and growth projections remain vulnerable to policy shifts, pricing pressures, and geopolitical alignment. India as a nation finds itself at an inflection point. If the country can build robust infrastructure, improve logistics, and maintain policy stability, it stands to capture a significant slice of the restructured global trade pie. But if it falters, it risks becoming a mere spectator as global giants resume business as usual. Let's be honest, trade deals are a lot like office politics. Everyone pretends to get along in the meeting, but the real game happens at the coffee machine. And in this case, India better bring strong chai because the global boardroom is getting crowded.
That's an intelligent way to put across. I am sure our investors must have gained the wealth of knowledge from this show. Now it's time to apply it. Stay with us on Market Pulse, where we decode global drama and deliver financial dhamal. Until next time, invest wisely and stay informed.